Alright, this is part 11b, paying cash dividends. Companies seek to acquire capital, money, by issuing bonds, issuing notes, and issuing stock. All of these things are financing mechanisms. So, we briefly mentioned bonds back in a previous video. We did talk about notes. We've talked about stock, but what's the purpose of all of this stuff? So, we're going to sell, as a corporation, stock in exchange for money. We would issue notes or bonds in exchange for money. So, both of these are ways that corporations acquire money, what we call capital. Now, there's a big difference between these two, right? One major difference between issuing bonds or notes and issuing stock is that the money obtained through bonds or notes has to be paid back. So if I borrow money from a bank in order to purchase something like a new building or a vehicle, I got to pay them back, right? If I get money from the owners by selling stock to them, I actually don't have to pay that money back exactly. It's not a loan per se. So, why do owners give money to corporations? They both want to make money, right? The creditors, lenders, people we borrow money from, and owners, stockholders, they both want to make money. Creditors make money by earning interest on the funds loaned to the corporation. How do stockholders, owners, make money if their investments aren't loans that have to be repaid? Corporations can provide stockholders with a return on their investment in, generally speaking, one of two ways. So let's look at a corporation. This is our fake illustration, right? With Cam, Jill, Tia, and Carl. And let's say that, as we looked at before, Cam, Jill, and Tia all bought 1 share of stock, and Carl has 5. And let's say they each paid $200 a share. So Cam gave $200, Jill gave $200, Tia gave $200, and since Carl has 5 shares, $200 apiece, he gave $1,000. Now, we can provide a return to these stockholders, right? They want to make money. One of the ways we can do that is through profitability, which leads to increased stock prices. So this is a fake graph that I made, not altogether unlike graphs you would see on real stocks, but for the most part, we're just saying here that the stock they purchased $200 a piece was at month 1. Okay, they purchased the stock, and by month 12, because of the company's performance and profitability, the demand for the stock has gone up and expectations for the future have risen, and so the stock is now worth $209.50. So are our stockholders happy? Well, it's hard to say exactly, but it's likely that they're okay with the direction the company's going in. Their investment in the company has grown. If they wanted to, they could sell the stock and they'd make $9.50 per share on the stock that they owned. So that's one way. The second way that they can do this is by distributing a portion of the profits back to the stockholders. So corporate profits here, owner here, we can give some of that back. Okay. Now, we do this through a mechanism that we call cash dividends. So a dividend is simply a distribution of profits to the owners of the corporation, stockholders. There can be common stock dividends and preferred stock dividends, as we discussed these two types of stock in the last video. Now, the rights of a common stockholder are to vote in matters related to the company, a right to share in profits or dividends, which is our topic of discussion right now, and a right to share in assets were the company to go bankrupt. So here we have our 4 stockholders, and they're in line ready to get dividends from the corporation. In order for them to do that, the payment of dividends has to be authorized by the board of directors. When it is authorized, the directors are said to have declared a dividend. So again, we talked about the board of directors in the last video. If you need a refresher on who they are or what they do and what role they play, you can go back and watch the previous video. But let's say that the board has decided to declare a 50-cent per share dividend on the common stock. 3 dates matter: the date of declaration, the date of record, and the date of payment. So, to illustrate this a little more realistically, I want to take a look at Hasbro. Hasbro is a corporation that, growing up at least, had a big influence in my life because of the things that I enjoyed that Hasbro produced. One of those things would be Transformers. So we're going to take a little bit of a jaunt back to the 1980s here for a second, just because I don't normally get to talk about this stuff, and I know you guys are a captive audience, so you can't really get away from it. So, Transformers, obviously, very cool toys and cartoon in the 1980s. G.I. Joe, another one of my favorite things growing up, playing with G.I. Joes and watching G.I. Joe cartoons. But Mask was a cartoon that I watched when I was a kid that was pretty cool, and I really liked it, so I figured I'd throw it in here. Mask was a show that had vehicles that changed and had weapons and all kinds of stuff. It wasn't on for very long. I think it was like 2 years maybe. But there you go. You can Google it later if you want to. Alright, so back to the real stuff here. So here's an announcement. Hasbro announces quarterly cash dividend on common shares. August 1st, 2018, Hasbro today has announced that its board of directors has declared a quarterly cash dividend of 63 cents per common share. The dividend will be payable on November 15th, 2018 to shareholders of record at the close of business on November 1st of 2018. So we've got 3 dates here. The first one we see is August 1st. And then we see a date, November 15th of 2018. And then finally we see November 1st of 2018. So what does this really mean? Well, August 1st would be the date of declaration. That's the date the board of directors says, hey, world, we're going to pay out a dividend. November 15th and November 1st, November 1st is the date of record. November 15th is the date of payment. So they're going to pay out the dividends on November 15th of 2018. That's when checks, they'll be sent in the mail if you think of it that way. November 1st is what is called the date of record. And so in order to know who the payments are supposed to go to, because we know that stocks are going to change hands all the time, right, back and forth every day, the people who own the stock on November 1st, the date of record, are the ones that are going to get the dividend. So if you don't own it on that day, you're not going to get the dividend payment. So these 3 dates are really important because we're trying to figure out how to do the accounting for these things. So on the date of declaration, date of record, date of payment, what do? We know there are 8 common shares out there for our company, right, Carl's Canoes, and the company board of directors declared a 50-cent dividend. So 8 times 50 cents, $4 total in dividends. And we would record it like this on the date of declaration. Dividends, sometimes people can use dividends declared as an account, but dividends is your account, $4, and dividends payable of $4. So we owe the money. Once we declare the dividend, we are obliged or obligated, right, to pay the dividend to the stockholders. Because if we later said, well, we've changed our mind, we're not going to do that, they probably won't be very happy with us. So we've essentially created a liability for ourselves by declaring the dividend. So we record dividends payable. The date of record, we don't have an entry to do anything here because This date is simply the date used to determine which stockholders are to receive the dividend. And then the date of payment, we are going to credit cash because we're going to give out the money, and we're going to get rid of the dividends payable liability. So we would debit that. So that's essentially how cash dividends work as far as the journal entries go. Now, Cam gets 50 cents, Joe gets 50 cents, Tia gets 50 cents, Carl gets $2.50 because he owns 5 shares. Preferred stock dividends are a little different. The journal entries are essentially the same. We still have the date of declaration, payment, all of that good stuff. But when we talk about preferred stock dividends, we have some intricacies we need to discuss. So the rights of a preferred shareholder, the right to share in profits or dividends, which is what we're looking at, and the right to share in assets for the company to go bankrupt. They don't vote, but they're first in line for dividends. So if here are our 4 owners, stockholders, and Carl is our preferred shareholder, okay, he is first in line for the dividends, quite literally in this case. So he has preferred stock, and the preferred stock is going to have what is called a dividend rate. So this stock we're going to say is 7% $10 par preferred stock. So what does 7% mean? The percentage associated with preferred stock is a dividend percentage. Not only are preferred stockholders first in line for dividends, they are also promised a fixed dividend amount per year. In this case, 7%. But 7% of what? There are 4 preferred shares outstanding. Carl has 4 shares of preferred stock. In our example, Carl's Canoes had 4 preferred shares of stock. Each had a par value of $10. And so if we look at the total par value of the shares, there are 4 of them. They each have a par value of 10. That is a $40 total par value. We are guaranteeing Carl, who owns the preferred shares, 7% of the total par value of the shares. So if the total par value of the shares is $40, 7% of that is $2.80 in a preferred dividend. Now, we have to also know whether this stock, preferred stock, is cumulative or not. If the preferred stock is cumulative, the company owes the stockholders for any years in which it does not pay dividends. If the preferred stock is non-cumulative, the company does not owe dividends in arrears. So basically what this means is Carl is promised $2.80 every year. If this stock is cumulative and the company does not pay this year or next year or the year after, when it comes to year 4, they owe Carl for all 4 years. So it builds. It's cumulative. If it's non-cumulative and they don't pay, he doesn't get anything. He's not promised to be paid dividends from prior years. Okay? And that's what dividends in arrears means. Being able to receive dividends that you were not paid in prior years. So in our case here, if the company, Carl's Canoes, the board of directors says we're going to pay $5 in dividends, well, as the preferred shareholder, okay, Carl is going to get $2.80 right off the bat. He is first in line. He takes his $2.80 right away. Whatever's left over, the $2.20 that's left over, well, that is what goes to the common stockholders for them to fight over. So that's kind of the way preferred stock works. Okay, whatever amounts are promised to the preferred stockholders, they're going to get first, and then whatever's left over goes to the common stockholders. So, in summary, cash dividends must be approved by the board of directors. Dates matter. When approved, the board of directors is said to have declared a dividend. The date of the declaration creates an obligation for the company and therefore requires a journal entry. Dates of record and dates of payment are also important in the accounting for cash dividends. Preferred versus common. Differences exist in the accounting for preferred and common stock dividends. Preferred shareholders are first in line and are usually guaranteed a specific percentage. And, as always, remember,